It's just a normal retracement after a big day. It's no big deal. Let's look at where we are, and this is what's the good news for the American people. If you simply look where we are now, we've got a 10% global tariff in place, and we're taking in about probably $4 billion a day. Well, we were losing $4 billion. We're taking in about 2 or 3 billion now. So that's all to the good. We're clawing back some of that dangerous trade deficit.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcast. It's Friday, the 11th of April. My name is Zubin Paracuelis, Chief Southeast Asia Economist at Nomura in Singapore. Global financial markets remain on edge after a rebound from the 90-day pause on U.S. reciprocal tariffs for most countries except China. Trade tensions remain high between the two countries, with U.S. tariffs against China now reaching a staggering 145%. Even though the Trump administration seems to be downplaying the market impact, as we heard from Peter Navarro in that earlier clip, the US dollar has been under some pressure despite US Treasury yields also rising. To try to get a sense of all these and what's ahead, I'm joined by our US economist Jeremy Schwartz, who discusses the path forward for negotiations with US trading partners. Andrei Shepeniak from our economics team in London discusses Europe's changing stance to negotiate rather than retaliate, and the ECB looking set to cut again next week. Jing Wang from our China economics team outlines the posture from Beijing on the negotiations, with the GDP data also on tap. We end with a special segment with Rob Subbaraman, our head of global macro research, who offers his perspectives on major global questions, including how damaging the tariff shock could be on global growth and possible reasons behind the ongoing decline in US asset prices. You don't want to miss that. Let's dive in. All right, let's start with the US. And Jeremy, welcome back to the podcast.
Thanks, Zubin. It's great to be back.
Yeah, so I guess the first question, which I think is top of mind, following the reprieve for the rest of the world in terms of the reciprocal tariffs, but still some tit-for-tat increases with U.S.-China. What are your thoughts on the implications of the U.S. economy, growth, and inflation forecasts?
Yeah, so President Trump announced a 90-day pause and lowered the reciprocal tariff rate to 10% for all trade partners, excluding China, where in contrast, he raised tariffs to 125%, which appear to stack on top of the 20% increase already announced in February and March. Cumulatively, this is actually not much of a reprieve in terms of the aggregate effective tariff rate. We currently estimate that at around 24%, down from 27% late last week after the original Liberation Day announcements. The big difference now is that more than half of the year-to-date increase in tariffs is due to China, meaning the growth and inflation impact is going to depend heavily on how quickly businesses can substitute away from Chinese goods. So markets certainly took it as a reprieve when there was the announcement, but we continue to see the cumulative effect of tariffs as a significant positive impulse to inflation and a serious headwind to growth. In terms of what's changed since last week, more concentrated tariffs against China could lead to a sharper spike in inflation pressure, but the possibility of substitution away should modestly reduce the cumulative inflation shock in the medium term, because you can go help to mitigate the effect of the tariff on final prices by finding alternative sources of supply. We continue to see tariffs as a severe but non-recessionary shock to growth. We are forecasting year-end average GDP at around 0.6. In terms of what changed since last week, I'd say near-term tail risks appear to have diminished somewhat. Trump's attempt to de-escalate after Wednesday's announcement indicates the administration is sensitive to financial markets, so that slightly reduces the risk of a negative feedback loop between tighter credit conditions and deteriorating growth. Focusing the trade restrictions against China also helps to define a strategy and path forward for negotiations with other trade partners. That said, risks to growth will remain heavily skewed to the downside. Despite this week's reprieve, tariffs are substantially more severe than us, or I think most forecasters had expected just early last week. And I would say the concentration on China adds some downside risk because you're causing acute stress for some businesses, which we think is more likely to lead to defaults and layoffs and the types of economic shocks that can kind of spiral out into those recessionary negative feedback loops.
Yep, that's interesting. And specifically on China, the tensions with the U.S. Still rising, as you mentioned there. How do you see the path of possible negotiations going forward, or are we in this standoff for a bit while longer?
Yeah, so I think the negotiations seem to be focused on non-China trade partners, and Trump floated the possibility of exemptions for specific countries or companies, and potentially even getting below that 10% across-the-board tariff rate for other trade partners. We certainly don't take it for granted that the trade restrictions have peaked at this point, and it's going to be a straight line towards more loosening. We think that there are still more sector-specific tariffs that are likely in the pipeline. And we think the negotiations won't necessarily go well for every trade partner. That said, I mentioned in the prior question, we do think that focusing on China rather than kind of hitting friend and foe alike is a positive development, since it helps to set the parameters for these negotiations and maybe makes it a little bit clearer to trade partners what they can offer in these negotiations to help achieve further concessions from the U.S. and maybe avoid that increase in tariffs 90 days down the line.
Yep, got it. And finally, any data releases in the calendar that you're watching closely for the U.S. next week?
Yeah, so of course we're in a bit of a no man's land in the data calendar where everything is lagged from before this sharp shock in tariffs and tightening in financial conditions. That said, retail sales for March out next Wednesday is going to be very interesting for giving some clues to the health of the consumer before you got into this tariff shock, and potentially any signs of front-loading purchases ahead of price pressures. So we are forecasting a strong reading for March. We think that's going to be largely driven by autos, but it should be a solid rebound after a couple sluggish months to start the year. That said, I think everyone is going to remain focused on market financial conditions, any signs of credit tightening, and then of course the weekly jobless claims numbers are going to give the best real-time indication of if there's any stress in the labor market.
Yep, excellent. Thanks so much, Jeremy.
Yeah, thank you.
All right, let's swing over to London, where my next guest, Andre, is joining me from. Andre, thanks for coming back to the podcast.
Thanks, Hubert, for having me. It's always a pleasure.
Great. So first up, I guess let's do the topic of the day, which is on tariffs and EU's response. We haven't heard much of late. Do you think this 90-day pause from Trump changes EU's tactics, try to be a bit more let's say, reconciliatory and negotiate and strike a deal with the U.S. as opposed to be retaliating?
I think that's exactly what that does, actually, Euban. So ever since the 90-day reprieve, already the European Union has announced a delay in terms of the countermeasures versus the aluminium and steel tariffs. So already Europe now is trying to almost backpedal or sort of tone down its response to the previously announced tariff measures. It's worth bearing in mind, obviously, this whole 90-day reprieve from Trump only amounts to the reciprocal tariffs above the 10% threshold. So the 25% aluminum and steel and the 25% on autos, as well as the 10% reciprocal, those still go into force and are in force. But nonetheless, it's this sort of extra 10% Trump has said to Europe, hey, look, I'm not going to charge you just yet. But already now, as a result of that, Europe is trying to offer an extra olive branch. And so the question is whether or not Europe can negotiate that incremental 10% away over the coming 3 months. Europe has announced that it's willing to look for 0 for 0 on core goods. So basically 0% US tariffs and 0% European tariffs. Let's see if Trump takes up that gambit. Trump has said he wants to look at VAT as well as non-tariff barriers, but let's see. All else equal, though, we are seeing tariffs higher versus, say, prior to Trump coming into power back on the 20th of January. And we think the EU still may look to provide some support to the most affected sectors. So firstly, we're looking at thinking that the Commission may lift state aid rules. That's quite important. Secondly, we think the European Commission might do new joint EU issuance dispersed via grants rather than loans. And so again, that's to support the most affected sectors, as even 10% tariffs is still more than versus what we had previously.
Okay, excellent. At least we're moving towards a path of de-escalation with respect to Europe. So that's some good news there. Now, on the ECB, which we'll have on Thursday next week, what is your expectation there on the policy rate and on the forward guidance?
Look, in terms of the policy rate change, we're forecasting a 25 basis point cut in the depo rate, so lowering it to 2.25% from 2.5% currently. In many ways, this is Trump's rate cut. Essentially, the announcement of Liberation Day tariffs, the subsequent financial market turbulence, and now the reprieve, we think that really will force ECB's hand to cut rates. Prior to that, it was more finely balanced, given how data was, given ECB speak. But this really, I think, pushes their hand. In terms of guidance, though, we don't expect much at this stage. We think they want to maintain that meeting by meeting approach and that sort of data dependence approach, given the elevated uncertainty. Our terminal rate is 2%, so a final rate cut in June following the April meeting. But obviously, it very much depends on where we are on tariffs between now and, say, the July meeting. Though we do think the European Commission's response should mean the ECB doesn't have to go below 2%.
Okay, very clear. And finally, Andre, any other data releases or events you're watching very closely in the week ahead?
No, I think the key thing really is on the UK, actually, more than the euro area. It's going to be data for the labour market, where wages is very much in focus, especially after the downside surprise in the most recent prints. And also we have inflation data as well, where the Bank of England is still clearly focused on services inflation. On both fronts, we think the data should come in line to support the Bank of England maintaining that gradual cutting cycle. We are forecasting one Bank of England bank rate cut per quarter in the middle month of each quarter, so the MPR meetings, with a terminal rate of 3.5% by February of next year. And we think the data essentially next week for the UK will support a further rate cut by the Bank of England at its upcoming May meeting.
Great. Let's leave it there. Thanks, Andre.
Thanks, you've been great as always.
Okay, let's go to Hong Kong, and I'm joined by Jing Wang from our China economics team. Hi, Jing. Thanks for joining the podcast. And I guess the first question for you here is, China's retaliation to Trump's reciprocal tariffs has been quite stern, which is very different from the initial approach of being measured. What do you think could lead to a negotiation with the U.S., and can that scenario happen soon?
Yeah, hey, Yuben. Glad to be here again. Yeah, so for this question, I guess it is more up to the U.S. side. The Chinese government has made it very clear they will fight to the end. And rather than rushing to negotiate, we believe China will just continue to retaliate whenever needed. China will focus on its efforts to mitigate this shock, tariff shock to its export sector, and support, mainly this domestic demand. Right now, these two big economies are stuck in a game of chicken, and it seems like that both sides are unwilling to back down, and we just don't believe there will be a grand bargaining anytime soon.
Okay, yeah, that's very important and very clear. Speaking of supporting the domestic economy, do you think a fiscal stimulus package from Beijing is on the cards?
Yeah, I think definitely. Beijing will ramp up a broad set of policy measures to counter this tariff impact. And actually, not just the fiscal, monetary is also on the table. And we are expecting, some triple cuts and rate cut, for this year. But you are right. Fiscal will be more relevant. The government has already approved a big package of fiscal stimulus for the whole year. at this NPC meeting in early March. So I think adding more incremental stimulus in the very near term is not that urgent for them. And perhaps just to do the front loading of those policy plan should be largely enough for now.
Okay, got it. That's what we're seeing as well from other countries in terms of front loading fiscal stimulus. Another question, which I think slightly sort of more important from my perspective, President Xi Jinping is scheduled to visit Southeast Asian countries, including Vietnam and Malaysia next week. I feel like there's a major event. So any quick thoughts there in terms of what this visit signifies? Is it China trying to strengthen ties further with the rest of the region amid this trade tensions with the U.S.?
Early this week, we had this central peripheral work conference, was held in Beijing. It is a really high-profile meeting. All the top leaders, including President Xi Jinping, attend the meeting. In history, this type of a meeting was only held twice. Last time when it was in 2013, about when the Belt and the Road Initiative was launched. And this time, this meeting, called efforts to boost the strategic tie with China's neighboring countries. Yeah, so it's very likely, for Beijing to become more engaged with those ASEAN economies, to stabilize the supply chain in the region and to, mitigate the impact from the U.S. tariff.
Okay, wow, that's super interesting. And finally, I know data these days are less relevant given all the focus on the tariffs, but for the week ahead, we've got China's Q1 GDP on tap. What do you expect there?
So we expect the real GDP to moderate from 5.4% year on year in Q4 to 5% in Q1. And this is just in line with Beijing's annual GDP growth target of around 5%. This year, China's economy, had a really relatively good start. This tech stock rally early on, may have boosted investment and consumption to some extent, and we also see, some boost from this front loading of exports and consumption. Yeah, but as now clearly, there are, very strong growth headwinds to the export sector, which is still, relevant sector for China, contributes, 14% of China's GDP in value-added terms. So we just expect the growth momentum to weaken, very sharply after Q1. I guess that could be the case for the rest of the world as well. So we just, continue to expect China's GDP growth to slow notably towards around 4% towards the end of this year.
Okay, got it. Yeah, thanks, Jing.
Thank you.
Singapore may or may not go into recession this year, but I have no doubt that our growth will be significantly impacted.
For the rest of Asia, we have a couple of key central bank decisions in the week ahead. On Monday, we get the policy statement from the Monetary Authority of Singapore, which we expect to ease its FX policy more decisively by reducing the slope of the senior policy band to 0 from 1%, due to the negative impact of the reciprocal tariffs on growth, as we heard there from Prime Minister Lawrence Wong, when core inflation is also declining. Indeed, we expect MAS to lower its 2025 core inflation forecast to 0.5 to 1.5 from 1 to 2%, and the advanced Q1 GDP estimate on a sequential basis to show a drop in growth to minus 0.4 Q&Q from 0.5 in the previous quarter. On Thursday, we get the Bank of Korea, and we expect the BOK to leave its policy rate unchanged at 2.75%, but with a dovish tone. Despite growing downside risk to the growth outlook, a likely extra budget would support a rate hold amid Korean won depreciation pressures and higher uncertainty over the impact of tariffs. BOK will stay patient for now before delivering a 25 basis points cut each in May and July in our baseline forecast. Okay, for our special segment, I'm really delighted that Rob Subramanian, our head of global macro research, could join us today. Hi, Rob. Welcome to the podcast.
Good Euban. Great to be here.
Excellent. Yeah, so a lot has happened, obviously, since Liberation Day. And as a team, we've made a lot of downgrades on our 2025 growth forecast in many parts of the world. When you aggregate these forecast changes, as you've done in a recent report, how bad do you see the impact of the tariff shock, as you put it, on global growth? And do you see countries or regions which are more hurt than others?
Yeah, it shows that it's pretty bad for the global economy. But probably, the biggest thing is still significant downside risk to our growth forecast. The uncertainty is, very elevated. And so we're going to have to see how that plays out. The other thing is just the mixed performances we see. So on the one hand, I would say the US is where we see the biggest stagflationary pressures, growth going down to near recession, inflation going up a lot. You've heard from Jeremy on that. And then the other side where we are pretty negative is Asia. You've seen the massive tariffs on China. But Asia is probably going to have more of a growth and disinflationary shock. And the risk is deflation, actually, in some countries. So quite different. I'd say Europe is probably the one where we haven't changed our numbers that much. Modest cuts to growth, modest rises to inflation. So it's really the US and Asia that we think economies are under most pressure right now.
Yeah, very interesting contrast. And I guess, as we've said, Asia is going to be hardest hit. And then in terms of this sudden 90-day pause in the reciprocal tariffs for the rest of the world, but not for China, what do you make of that? Is this now signaling that the Trump put is now in play?
So firstly, I think it's really interesting, the pause on reciprocal tariffs for non-retaliatory countries, so essentially everyone except China. It does look like the US trade war is now shifting, aiming mostly on China. That, to make sense to me, that China is the US's biggest adversary and competitor. The Trump put, I do think it's now in play. I think there's a few issues around this. I think Trump may have actually lost some leverage now in negotiating with other countries, because other countries know that Trump is sensitive to US markets. So that's one thing. He's already lowered the tariff rates for at least 90 days. Two, our market's going to test the Trump put. If the interesting thing is, I think going forward in coming weeks, the Trump administration is going to try to promote that they're reaching phenomenal deals with some countries. But at the same time, I think the economy is going to show more and more signs of weakening growth and rising inflation. And the markets could come under pressure again, and hoping for this Trump put to come back into play again. And if it doesn't, that could be pretty bad for the markets. And the last thing I would say, with inflation rising, I don't think we're close to a Fed put. So there is this risk, I think, that markets are hoping that the Trump put comes back again, and it may not. And I don't think we're close to a Fed put. So I'm pretty cautious at the moment.
Yeah, that's clear. And I guess staying in the US, you've also made this argument that the world is heavily invested in US exceptionalism, and that if we go into a US recession, you could argue the probability of that is rising because of the tariffs. That could induce what you call non-linear effects and capital outflows hurting the dollar, which seems to be happening already. Could you elaborate on that argument?
So I think that's one of the most interesting market signals we've had this week. Is we've had the triple declines. So declines in US equity market, decline in US bond prices, and decline in the US dollar. Now that's pretty unusual. In particular, 10-year Treasury yields rising to close to 4.5%, and the dollar now this year down kind of around 10% in DXY terms. I think this is really questioning a few things. So one is US exceptionalism is being questioned here because the US economy, with staring at stagflation going forward is clearly a concern. But I think it's interesting that, even with rising US bond yields, the dollar's weakening, and that might say more than just weak growth and inflation going up in the US. It may be that the market's starting to focus a bit more on the US bad fiscal position, but also the reputation of the institutional infrastructure in the US and relations with other countries may be questioned now. And so this could be, we will see, but is this the start of kind of the US dollar status as reserve currency starting to come under threat? Are we at the early stages of the end of King US dollar? I think it's going to be very interesting. I think that this is probably the highest risk that it could be the case for a very long time. So we'll be watching this space very closely.
Okay, thanks. And finally, with all this uncertainty globally, do you see any bright spots?
It's right now, it's hard to see clear bright spots. But, I would say as the dust settles on the US policies, impacts in the rest of the world, in the DM world, I think Japan is going to be relatively less scathed. I think Japan is a relatively closed economy. And its domestic economy is actually showing more vigor. It's coming out of deflation and has very loose monetary fiscal policies, still a weak yen. So I think Japan is interesting. Then the other one is India. In the EM world, I'd say India is the one that could be a bright spot in terms of, again, a relatively closed economy, huge domestic market, and can benefit from diversification of multinationals away from China. And, if anything, I'd say India also is potentially for the US a good counterweight against China. So from a hedging perspective and foreign policy, I think India is well positioned as well. So yeah, those two, India and Japan, I think are the two that I would watch as potential bright spots in the medium term.
Right, brilliant. On that note, we'll leave it here, Rob. Thanks very much, and thanks for the great insights as well.
Thanks, Ewan.
That's it for now, and thank you again for joining us at Nomura Research on the Week Ahead, edited and produced by John Dalton. If you enjoyed the content, please like and subscribe to Nomura's podcast on Apple, Spotify, and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can also check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.